Hey, welcome back, everybody. And we're doing a remote market update. I happen to be at a educational conference here, and yeah, not a bad room. So anyway, sitting here, going through the different metrics, and it's so funny because as we're going through basically what is happening in the mortgage rate industry, as far as trends and whatnot, that's going to be a major deciding factor as to what buyers do in today's market. So let's hang on and let's get to it. All right. So if you go back and you take a look at some of the other videos that we've done, and in fact, going back as far as August, we talk about what's going to happen, at the last quarter of 2024. We talk about predictions for 2025. And so funny enough, we actually had a news article that came out from US News, super awesome. And it conforms and is right in line with what we're saying with mortgage rates, because they gave mortgage rate predictions showing that as we head into the last quarter of this year, we're going to start seeing rates come down. With that, into 2025, we're going to start seeing rates head into about the 5.75. So mid to high fives, real low sixes. And that is super important to understand, because mortgage rates are probably one of the biggest motivators for buyers coming into the market, and has a direct proportional impact on inventory and pricing. So unfortunately, like right now, affordability is one of the biggest challenges that we are seeing, because home prices keep going up, even though we have seen, our mortgage rates kind of do some bobbling. And in fact, most people thought that I was kidding when I said, hey, this last, not the time before, when the Feds dropped rates down to a half a percent, most people are like, hey, that's great. And I'm like, no, that's probably bad. Rates are going to probably go up. And they did. And in fact, they went up every single week until just recently, when, yes, the Feds did drop a quarter, but the difference is we're going to see rates coming down because they're seeing that as a healthy move by the Feds. Now, again, super important to remember, the Feds do not control long-term mortgages. Okay. And in fact, if we pop back here, this is the best way. So mortgages are based and are priced based on bonds that move every single day. The Feds, right, they get together once every 6 weeks. And because the Feds only get together once every 6 weeks, they control your HELOCs, your home equity line of credit. If you're getting a car, what that car interest rate loan will look like. Your credit cards, that changes every day. What banks lend to on a day-to-day basis, that is what the Feds control. Now, when we talk about actual long-term mortgages, 15-year mortgages and 30-year mortgages, again, those are based on the bond rates. They're based on the stock market. There we go. That's what I was trying to get. I was going to say the interest rate, but that's not it. It's based on the stock market. And so just like the stock market goes up and down every day, so do mortgage rates. Whereas, again, remember, the Feds only get together once every 6 weeks. There you go. Now, yes, that means that they will be getting together again here shortly in December. However, no, I'm not expecting a whole lot out of that one. We did anticipate a quarter percent in rate drop, and that's going to help the folks with credit cards. That's going to help the folks with who's buying new cars. That's going to help commercial lending and things like that, and people with their HELOCs if they're adjusting, because it's going to come down just a little bit. Now, all things considered, then, what does that mean? So if we take a look at our headlines here, in the upper left-hand corner, you can see mortgage demand regressing amid rapid rate spike. So we're actually seeing a little bit more caution from a lot of buyers, not unexpected, because it's been a little bit volatile. One of the other ones, tricky day, mortgage rates fall significantly, but not because of the Fed. And you might say, what are you talking about? Yeah, so actually, funny enough, because it is based on the stock market, we had employment numbers that came out before the Fed's announced, right? Plus, we had some other metrics that came into play that the industrial investors actually looked at and decided, oh, you know what? Yeah, we kind of like this. So they moved back into bonds. When you move back into bonds, mortgage rates come down. When your 10-year treasury goes down, you'll see mortgage rates follow it. They're not attached to it. They're not linked to it in any way, but they freakishly follow it. And that's super important to understand and a really good metric to kind of keep an eye on as you are looking at making that move for when the time is right. Hence, that's what this information is all about. Now, when we come back, you can see that we're actually down just a tad bit, down to 6.92. That is what they are trading at. That doesn't necessarily mean what certain mortgage rates are being published at, because there's a lot of different banks, depending on what profit margin they want to take, depending on what program they're running. There's a lot of metrics. In fact, make sure you watch the video, 5 questions that you should be asking when getting quoted mortgage rates. Super important for you to understand. Also, when we come back here, bottom right-hand corner, look, there's a, hey, if you bought a home and should I refinance, that calculator is going to become super, super important for you as you are getting closer into, December and then into first and second quarter of 2025, because as rates come down into the 5s, and I am predicting that, that really at that point, you need a 1 full percentage point, to make a refinance make quite a bit of difference. And again, taking a look at time in the loan, cost of the loan, things like that. All right. Not a mortgage broker. I am a real estate broker, but the two go hand in hand, understanding, making sure that you guys get well educated on where we're at. So when we take a look at some of the Freddie pricing, Freddie's got our 7-day running average. We did not have access to that one. Their site was down briefly. But they're in the 6.85% from what I saw the day before yesterday. They're probably pretty close to that. They should be dropping back down again as we see some of our trending with now that the unknown about who's going to be in the administration. Like you heard us before, they weren't really wild about who really was going to be there. There's pros and cons to each one. This is not a yay Trump, yay Kamala. It has nothing to do with that. This is more, how do the industrial investors look at who's going to be in the administration? What policies should they start anticipating? And how is that going to affect both the economy and how is the world going to respond to this? And again, because it is based on the stock market, as we all know, the stock market is subject to a lot of what is going on in the world and its perceptions. That, again, will dictate your mortgage rates. All right, moving on. So as we head into what's going on with these metrics, let's pull these up. All right, so again, our actual stats for days on market, they've gone up just a little bit, and that will change. I am anticipating that as rates start coming back down, that we will see a few more homes going off market. So when we take a look at our running 7-day average, you can see that we had 737 homes that came on market. Okay, that's fine. When we take a look at what Pended, however, we're at 1,160, almost 1,200 homes that went off market. So you can see that we still have a number of homes that are going on market, but we're seeing more homes going off. Now, here's what's super important. As we continue down, as rates continue to come down, the the prediction is going to be that normally after Thanksgiving, things start to slow down just a tad bit. If rates start to head back down into the lower sixes, so you might remember when the Feds dropped their rate, we were actually at 6.02%, basically 6% for mortgage rates, right? Okay. Now, that's new money, not refinance money, new money. New money is always cheaper. Now, if, however, we actually had rates dip down into, say, the high fives, we're going to see a lot of those buyers coming out, and we're going to continue to draw down more inventory, all right? Versus where we're at today, which, after the Feds dropped their rate, we actually went up, and, we were bouncing right up against 7%. We actually crossed over, then we came back. We're down just a tad bit lower than that, which is really good. However, if we start hitting into the high fives, all those buyers that are waiting in the wings, that pent up buyer demand, those folks are going to be hitting the market. We're going to start pulling down on inventory, and home prices are going to start going back up, just as if we were coming back out of a recession. Back out of a recession. Since we have been struggling with that, and then, of course, depending on what the administration does, in which they were actually started some things a little early, but nonetheless, depending on how that perception is, we could see rates down into the mid fives instead of the 5.75 and higher. That's more where I see us at. So when we come back and we take a look at the inventory, you can see that the number of canceled and expireds absolutely fell off. Number of homes reduced actually fell off also, as we started to see quite a bit more activity. Now, as we roll into what's going on in the market, remember, if you like this, subscribe. Here's the funny thing. There's no marketing here. We just want to get you the best information. Just like it. Let YouTube know so that others can see this free information. So it makes it super helpful for everybody. All right, moving on. I guess that's my one little commercial. Let's talk a little bit about the metrics on volume and what's happening here. So as you can see on the right, we have our year to date, and then we have our month to date. And let's blow that up a little bit bigger for you. Now, so our year to date, we're up 5.5% as far as Pended, 3.8% year over year. And we have been gaining this ground where we were in the negative numbers for the first half of the year. The latter half of the year, we've actually been doing super well. In fact, when we just take a look at November alone, that's supposed to be an S. It's super hard to write with my little keypad here. But anyway, that's September and October. So when we talk about closings being up 13.8%, what's super important to understand is, remember, in the month of October, pendants were up 43%, right? All right. Now, so if we were up 43% for pended in the month of October, and again, solds are always looking in that rear view mirror, that means that what we're really seeing with these solds is September and early October, right? Because we haven't hit our average 30-day close, because we'd only be closing things that happened up to about October 7th, 8th, 9th, right in that window. So as we get further into November, you're going to see those solds actually start to ramp up. And when let's come back to the chart, we'll blow it back up here again, because our sold or our pended for September is already up almost 300 homes. Hey, listen, when we take a look at where we're at with the anticipation of mortgage rates coming down, we could very well have a very aggressive December market, just like we did in 2020, which historically is a slower month. So, post Thanksgiving through December, through most of January, that is historically a slower month. And if we go back to a chart, in fact, let's just do it. Let's just go back to that chart. So if we come back here, you can see where the dip is, and that dip is in December, January on the left-hand side there, which is very consistent. It's seasonally normal, okay? Then as we come in and we start coming back into February, that's our spring market. So the real question then is if we're going to see some of these metrics change, right? If we're going to start to see these numbers change to where we are going to have a higher number of pended homes in December, that's going to start drawing down to where we hit the lower numbers of the 1 month, 1.5 month of inventory. And that is going to then create that, sense of, hey, I need to get this. What is it? They call it FOMO, fear of missing out. I need to buy my home. Rates are lower. All these buyers are going to come in. We're going to start drawing down inventory again. And we're already less than half of where we should be because we're at about 2.2, 2.3 months of inventory. So mortgage rates, again, are going to have a massive impact on what we're doing and how we proceed. And then, of course, that is going to continue in Q1, Q2, as we see our spring market being very aggressive. Buyers are going to really love our spring market this year. I think we're going to have lower interest rates, and we're going to have a lot of buyers who've been sitting on the sidelines now come into the game, both residential and condo sales. Investment wise, that's going to be a sweet spot for a lot of investors, because that also means that you're going to be able to get better pricing based on the fact that interest rates for investment properties, that's 4 units or less, commercial, then you hit the Fed numbers. Those numbers are going to be super solid. All right, moving on. We digress. All right, so when we move over and we take a look at new construction. So new construction, again, is doing super well, especially last month. And you guys might remember, some of the ads that we were showing where they were really incentivizing, and some of them as much as 30% for, or not 30%, but $30,000 towards upgrades, loan buy downs. They were offering loans basically at 4% for the first 1 to 2 years, and then it would stay fixed. I think it's in the high fives or so, about where it's going to be. But as you can see, even though their Pended is up, which is what the big numbers came from, overall sales are still kind of lagging a little bit year over year. And that's because we had a lot of new homes, or resale homes, people who own a home, a used home, I guess you could say, that's a resale. That influx came in and took away those buyers. And so builders had to incentivize. Now, we're still one of the top 5 markets across the United States, and we continue to grow. We've seen approximately a 5 to 8%, depending on area, appreciation year over year as far as home values. And that's going to be carried forward to where we could very well see a 10% return year over year in home values as rates come down, and again, adversely affecting home affordability. Anyway, moving on. So when we move from there and we take a look at bank-owned homes, again, that hasn't changed a whole lot. Bank-owned homes right now, REOs, real estate owned, they're not a great investment. We do not have a lot of them. 19 of the homes that show to be published, those really are not even, they're not even real. They're just mismarked by the agents, or what we call the wall of shame. So looking at all of this, you can see, again, even if we did have 111 homes, which we do not, that's 3/4 of Washington state. That's just a very, very small number, super small. And those homes, they tend to be overpriced because they have to show that they got to the investor, that they got maximum dollar value, or at least tried to, and then as they reduce price, and they get that return. So if you have any questions, please reach out. Hope you enjoyed this video. Again, remember, smash that subscribe button. Have a little bit of fun with it. Hey, and remember to share this, but more importantly, like the video if you would, please. And in the meantime, you guys have an absolutely beautiful day, and I will see you on the next video. Take care.